Welcome back, guys. In today's video, I'm going to explain to you how you can leverage the power of the tax code to write off a variety of everyday expenses. I'll also be answering some key tax questions from some of my subscribers right at the end of this video. So without further ado, let's dive in. All right, first thing we're going to cover is employees versus business owners, because not everyone is allowed to take the same expenses. In fact, a general rule of thumb is that business owners are eligible for a much wider array of tax deductions compared to W-2 employees. And the reason why this is the case is because the IRS views being an employee significantly less risky compared to being a business owner. You see, business owners often have to invest their own money. They have to make difficult decisions that can make or break the business, and they have to hire and fire employees. All of these things take a lot of risk, but the country still desperately needs entrepreneurs to create businesses so that people can have jobs and that our economy can continue to thrive. So the IRS creates tax benefits for business owners that can help to incentivize them to create and run businesses. You see, under Code Section 162A, when it comes to tax write-offs for business owners, this is arguably the most important internal revenue code. Code Section 162A states that business owners are allowed to deduct expenses that are ordinary, necessary, and reasonable in the pursuit of the business income. What this means for you, taxpayer, is you can potentially write off thousands of different kinds of expenses as long as you make them in the pursuit of business income. This opens up an entire world of tax deductions that you could potentially qualify for, but not everything. Now that we've talked about why business owners are allowed to write off everyday expenses, let's go over some of the expenses that you could potentially write off on your tax returns, starting off with home-related expenses. If you work from home, your home office is your primary place of business, and if you use your home office exclusively and regularly for work, then you will most likely be able to write off your home office. Your home office does not necessarily have to be an actual office space. It could actually be an old bedroom that is converted into an office, or a section of your basement, or even an unattached garage, a studio, or a greenhouse. Because your home office is located at your home, you get to deduct a portion of the everyday expenses associated with your home. These expenses can include mortgage interest, rent, your internet, electricity, your renter's insurance, and much more. There are two ways to claim the home office deduction. You can use the simplified method or the regular method. With the simplified method, you can deduct $5 for every square foot for a total of up to 300 square feet. This would result in a maximum amount of deduction worth up to $1,500. Now, the regular method is more detailed. With the regular method, you can calculate the percentage of your home that you use for business and apply that percentage to your actual home expenses. For example, if your home office is 200 square feet and your home is 2,000 square feet, your office would be 10% of your home. You can deduct 10% of your eligible home expenses. So if you have a home office, you could potentially get a significant tax deduction for many of the costs associated with your home, overall reducing your tax bill. But what about your laptop? You see, most business owners in the modern day need a laptop. Laptops can be used for a wide variety of business purposes. For example, you may use your laptop to send emails, create documents, set up advertising campaigns, and do basic graphic design or build out a website. But the good news is that the IRS allows you to write off a laptop because it is a legitimate business expense. Now, you might be wondering, what about if I don't use my laptop 100% for business? This is a good question. The answer is that the IRS allows you to write off that percentage of your laptop that you do use for business. So if you bought a laptop for $2,000 and you use the laptop 80% of the time for business, then you would be able to claim 80% of the laptop's cost on the tax return, which would translate to about $1,600 in a deduction. But what about your cell phone? Just as you can write off a laptop if you use it for business, you can also write off a cell phone if you use it for business as well. The same rule applies to computers and cell phones. So you can write off the portion of your phone expenses that you use for your business. So if you buy a very expensive iPhone that costs $1,000 and use 60% of the business phone, you can write off $600 of that $1,000 that you spent for that iPhone. And if you happen to have more than one phone that you use for business, then you can write off the other phones too. Don't make the mistake of thinking you can only write off one of your phones if you have more than one. Vehicles. In order to write off vehicle expenses, you must use your vehicle for legitimate business purposes. The deduction that allows you to write off vehicle expenses related to the business use of your vehicle is called the vehicle tax deduction. Just like the home office tax deduction, there are several ways to calculate your vehicle tax deduction. The first is called the standard mileage method. With the standard mileage method, you track how many miles you drive for business purposes and then multiply those miles by the IRS approved rate. This method is particularly useful for people who want to simplify simplify their tax deductions. In 2025, the standard mileage rate is 70 cents. Personal miles do not count, only business miles. So if you drove 1,000 business miles in 2025, you would get a deduction of $700 using the standard mileage method. Now, the second way to calculate your business mileage is with the actual expense method. As the name implies, the actual expense method involves adding up all of the costs incurred for operating your vehicle. If you multiply all of these expenses by a percentage of time that the vehicle is being used for business purposes, it could be substantially large. Let's say that you use the vehicle 50% of the time for business purposes, and this year there was $10,000 worth of expenses. You would be able to deduct $5,000 of the actual expenses on your tax returns. It's also possible to write off a massive portion of all of the vehicle's purchase price using Code Section 179 and bonus depreciation in the first year. If you would like a detailed breakdown of how to use Code Section 179 and bonus depreciation to write off your vehicle, then check out this video right here. How about meals? This is one of my favorite everyday expenses to write off. If you own a business, then you can write off 50 up to 100% of your cost of your business meals. However, there are stricter rules for writing off business meals that you need to be aware of. For example, the meal must be directly related to your business activities. This means it should have a clear business purpose, such as a meeting with a client or discussing business strategies or entertaining potential business partners. But for most business meals, you can write off 50% of the costs. This includes meals with clients, customers, business associates, and the COVID-19 pandemic relief allowed businesses to write off 100% of qualifying meals through 2022 purchased from a restaurant as a ways to help the restaurant industry. However, the expansion of this deduction for COVID has expired, and now this deduction is back to 50%. So if you're providing meals for employees at the workplace, such as lunch for your team during a meeting, these meals may be fully deductible depending on the situation. So it is important to keep detailed records to validate your business meal deductions. The IRS requires the following details for business meals: date, location, amount spent, including the tip. Now, what about the business purpose? Why was the meal or the business-related event happening? This is one of the most important parts. And plus, if you have a list of all of the people you ate with, this is now you doing what's called best practices as a business owner. As long as you follow all of the rules and document your business meals correctly, you can potentially save a substantial amount of money by simply eating every single year. Last but not least is travel. Many of us love to travel, and I definitely am one of these people. One of the nice things about being a business owner is that sometimes it does give you the opportunity to travel. If you are a business owner, then there are a wide variety of travel expenses that you might be able to write off. For example, you might be able to write off transportation costs, such as airfare, bus tickets, train tickets, or car rental fees. You might be able to write off your lodging costs, such as staying at a hotel, a motel, or an Airbnb. Plus, there can also be many other miscellaneous fees that you can deduct while traveling for business, including tips to bellhops, hotel staff, or taxi drivers, access fees, baggage fees. All of these things are important when traveling for business. But first, the trip must serve as an actual business purpose. For example, you might be able to go meet with a new supplier conducting market research, looking at a site for a new office. If you're just going to visit your Aunt Susie in Las Vegas because you haven't seen her in a while, and you also want to play some blackjack, that's not going to fly with the IRS. Keep in mind that you're going to need some type of documentation to justify your business travel expenses. The more documentation you have, the better. So keep copies of your receipts, create a travel log, and even keep a record of your business itinerary if you can. Be aware that as you take more and more write-offs and make more and more money, these things become extremely important to you. Be aware, to write off travel, you have to leave your tax home. A tax home is the general area of your main place of business or employment. So if you live in Charlotte, North Carolina, the city of Charlotte would be your tax home, and you would have to leave Charlotte in order to write off your business travel expenses. You can't just post up at a hotel right down the road from your business location for a few days and write it off as a business expense. It doesn't work like that. All right, moving on. Here's a question that came in from one of my subscribers that I'm going to answer. I get a lot of these questions, but before I do so, I just want to remind everybody that if you're watching this video right now, you still have time to sign up for the Tax-Free Wealth Challenge. This is a virtual event taking place on March 10th through March 14th. It's the biggest digital tax conference in the world. I put on this conference for 5 days to spend time with you, showing you tax strategies that the top 1% of tax earners are leveraging every single year. The link is in the description below if you're interested. Now back to the subscriber question. This question came in from JC Assist on my crypto crypto tax updates for 2025 you need to know. Check out that video if you have not seen it. The question is can I use the losses from my crypto to offset my taxable income or get a refund? The answer is yes, but you're only able to use up to $3,000 of capital losses against other forms of income such as W-2 or 1099. And yes, you can receive a refund from it. My name is Karlton Dennis. If you like this video, I need you to do something for me. Like, comment, subscribe. You know what it is. I need to see that feedback, and I look forward to seeing you on the next video. Cheers.